Welcome to Tax Planning for Investments. You know, I hear from accountants all the time that they struggle with how to discuss things like this with their clients to get them really excited about the possibilities. For that reason, I'm going to explain these strategies just how I'd explain it to my clients so that it gives you some ideas. The bottom line is be honest, be energetic, and be excited about the tax savings, and they will be too. It's important to understand the potential tax consequences of buying, holding, and selling any investment. And while these rates don't change very frequently in terms of long-term capital gains rates, keep in mind that that's tied to the income tax brackets. And so as those are adjusted every year for inflation, that's going to affect your long-term capital gains rates as well. But remember, don't let tax considerations control your investment decisions. Although time, not timing, is generally the key to long-term investment success, timing can have a dramatic impact on the tax consequences of investment activities, and that's where we come in as tax planners. Your long-term capital gains rates might be as much as 20 percentage points lower than your ordinary income tax rate. And even with the reductions to most ordinary income tax rates under the new TCJA rules. Now, the long-term capital gains rate generally applies to investments that are held for more than 12 months. And because of changes to the brackets, that means the 20% rate is going to kick in before the top ordinary income tax rate does. In fact, you can earn almost $600,000 in taxable income as a married couple joint filing before you experience the 20% capital gains rate. Now, let's not forget the 0% capital gains rate. That's often overlooked, and it could be utilized as well to reduce the amount of tax that's paid now. Now, as you can see on this slide, which rate applies depends on your income and the type of asset sold, which asset you're holding on to, and typically if you hold on to that investment until you've owned it more than a year, that may help substantially cut tax on any gain. Remember, appreciation on investments that don't generate current income aren't taxed until sold, deferring tax and perhaps allowing you to time the sale to your tax advantage. For instance, in a year when you have capital losses to absorb the capital gain. Or if you've cashed in some big gains during the year and want to reduce your tax liability, before year end, look for unrealized losses in your portfolio and sell them to offset your gains. Keep in mind that substantial net long-term capital gains can trigger the alternative minimum tax. Now, if you're trying to achieve a tax loss with minimal change in your portfolio's asset allocation, keep in mind the wash sale rule. The wash sale rule prevents you from taking a loss when you sell a security if you buy a substantially identical security or option to buy that security within 30 days. Now, this 30-day period applies both before or after you sell the security that created the loss. You can recognize the loss only when you sell the replacement security. This is to prevent you from going in at the end of the year, liquidating to generate a loss, and then picking up virtually the same investment again. So you can avoid the wash sale rules and still accomplish some of your goals. Now, you may be wondering what a bond swap is. Here's how it works. You sell a bond, you take a loss, then immediately buy another bond of a similar quality and duration from a different issuer. Sound familiar? Generally, the wash sale rule doesn't apply because the bonds aren't considered substantially identical. Thus, you achieve a tax loss with virtually no change in economic position. Now, if you happen to be investing in crypto as well, the wash sale rules do not apply when you're selling digital currency. Now, if net loss exceeds net gains, you can deduct only $3,000 or $1,500 if you're married and filing separate of those losses each year against other income like wages, self-employment income, business income, etc. But you can carry forward these excess losses until death. Loss carryovers can be a powerful tax-saving tool in future years if you've got large investment portfolios, real estate holdings, or closely held businesses that might generate substantial future capital gains. Finally, remember that capital gains distributions from mutual funds can also absorb capital losses. Higher income taxpayers also need to consider the net investment income tax in their timing strategies. If your modified adjusted gross income, or MAGI, is over the applicable threshold listed on this slide, you're subjected to this extra 3.8% tax on the lesser of your net investment income, or the amount by which your MAGI exceeds the applicable threshold. Now, there had been discussions of repealing this tax, but as of now, that hasn't happened. So you want to do some planning to avoid net investment income tax as well. And that can also include capital gains, dividends, interest, and other investment-related income, but not self-rental income when it's an active trade or business. Many of the strategies that can help save or defer income tax on investments can also help avoid or defer net investment income tax liability, such as using unrealized losses to absorb gains. So make sure you calculate that in your savings. Not only are you saving capital gain, but the NII tax as well. And because the threshold for the NII tax is based on MAGI, any strategy that reduces your MAGI, such as making retirement plan contributions or income shifting, could also help avoid or reduce net investment income tax liability. Now, the 0% rate is not only my favorite, but applies to the long-term capital gain that would be taxed at 10% or 12% based on the taxpayer's ordinary income tax rates. So you just look up in the chart and that gives you the threshold. If you have adult children in one of these tax brackets, consider transferring any appreciated assets to them so they can enjoy the 0% rate. You might also consider timing strategies to take you right up to the limit with that 0% bracket. This strategy can be even more powerful if you'd be subject to the 3.8% net investment income tax or the 20% long-term capital gains rate if you sold the assets. But you have to consider any gift tax consequences. Also, if the child is going to be under the age of 24 on December 31st, make sure he or she won't be subject to the kiddie tax. For children that are subject to this tax, any unearned income beyond $2,400 is generally taxed at a higher rate. Now, we'll discuss the kiddie tax in more detail a little bit later. If you don't pay attention to the details, the tax consequences of a sale may be different from what you expect. For example, the trade date, not the settlement date of publicly traded securities, is what determines which year you're going to recognize the gain or loss. And if you bought the same security at different times and prices, and you want to sell high tax basis shares to reduce your gain or increase a loss and offset other gains, be sure to specifically identify which block of shares is being sold. This is a viable tax strategy because it ultimately leads to less tax. Now, investing in mutual funds is a really easy way to diversify your portfolio, but you have to be aware of the tax pitfalls. First, mutual funds with high turnover rates can create income that's taxed at ordinary income tax rates. So choosing funds that provide primarily long-term gains can save you more tax dollars because of the lower long-term rates. Second, earnings on mutual funds are typically reinvested, and unless you or your investment advisor keep track of these additions and increase your basis accordingly, you may end up reporting more gain than required when you sell the fund. So tax advisors, make sure you're using the right basis here. Brokerage firms are required to track and report to the IRS your cost basis in mutual funds acquired during the tax year, but the statements may not always reflect the accurate basis. Third, buying equity mutual fund shares later in the year can be a costly tax disadvantage. And that's because such funds often declare a really large capital gain distribution at year end. Now, if you own the shares on the distribution's record date, you're going to be taxed on that full distribution amount, even if it includes significant gains realized by the fund before you even owned the shares. You definitely don't want that. You're going to end up paying tax on those gains in the current year, even if you reinvest the distribution. Now, by purchasing stock in certain types of small businesses, you're not only going to be able to diversify your portfolio, but you'll enjoy preferential tax treatment. For example, if you sell qualifying Section 1244 small business stock and you sell it at a loss, you can treat up to $50,000 or $100,000 if you're married as an ordinary rather than a capital loss, and that's regardless of your holding period. So this means you can use it to offset ordinary income, reducing your tax by as much as 37% of this portion of the loss. Keep in mind, though, that Section 1244 applies only to total capital investment when it's less than $1 million. Generally, taxpayers that are selling qualified small business stock are allowed to exclude up to 100% of their gain as long as they've held that stock for more than 5 years. But depending on the acquisition date, the exclusion might be a little less, and that's because the rules have changed. It's also important to be aware that for qualified small business stock acquired before September of 2010 that's eligible for an exclusion, the taxable portion of any qualified small business stock gain is going to be subject to the lesser of your ordinary income tax rate, or 28%, rather than the normal long-term capital gains rates. So if the 28% rate and the exclusion apply, the effective rate on the qualified small business stock gain is going to be 14%. We just take 28 multiplied by 50%. Now let's say you've invested in a trade or business in which you don't materially participate, and where income or loss flows through to your tax return. You got to keep in mind the passive activity rules. Why? Because passive activity income may be subject to the 3.8% net investment income tax. And passive activity losses generally are only deductible against income from other passive activities. Now you can carry forward those disallowed losses to the following year, subject to the same limits. To avoid the passive activity treatment, you have to materially participate in the activity. Now that typically means you're going to participate in the trade or business more than 500 hours during the year, or you demonstrate that your involvement constitutes substantially all of the participation in the activity. Now, even if you do pass the material participation test, be aware that your loss deduction might still be limited under tax reform's rules for deducting business losses. If you don't pass the 500-hour test, there are several ways you can minimize negative tax consequences. One is to increase your involvement before the end of the year. If you can exceed 500 hours, the activity no longer will be subject to passive activity rules, and thereby the limitations. Another option is to group activities together to be treated as one activity for tax purposes and exceed the 500-hour threshold. That way you're applying the test to the group as a whole. But the rules are complex and there are potential downsides to consider. One more option, if you have passive losses, is to limit your participation in another activity that's producing income so that you don't meet the 500-hour test on that. Alternatively, invest in another income-producing trade or business that will be passive to you. Under both strategies, you'll have a passive income that can absorb that passive loss and essentially be tax-free. Finally, remember that disposing of the activity generally is going to allow you to deduct all passive losses, including any loss on disposition. Now that's subject to basis and capital loss limitations, but again, the rules can be complicated. Qualified dividends are taxed at the favorable long-term capital gains rate rather than your higher ordinary income tax rate. Interest income is generally taxed at ordinary income tax rates, which are now as high as 37%. So stocks that pay qualified dividends currently might be more attractive tax-wise than other income investments such as CDs, money market accounts, and bonds, but there's always exceptions. Some dividends, for example, are subject to ordinary income tax rates. I have a few on the slide for your convenience. The tax treatment of bond income can vary widely. For example, interest on U.S. government bonds is taxable on federal tax returns, but generally exempt on state and local returns. Interest on state and local government bonds, on the other hand, is excludable on federal returns. So if the bonds were issued in your home state, interest also may be excludable on your state return. Now, your state and municipal bonds usually pay a lower interest rate, but their rate of return might be higher when you compare the after-tax rate of return for a taxable investment. And that all depends on your tax rate. So to compare apples to apples, you really need to calculate the tax equivalent yield. It's really very simple. The tax equivalent yield equals your actual yield divided by 1 minus your marginal tax rate. Corporate bond interest is fully taxable for both federal and state purposes. Bonds, except U.S. savings bonds, with original issue discount, build up interest as they rise towards maturity. You're generally considered to earn a portion of that interest each year, even though the bonds don't pay it out to you annually. You gotta still pay tax on it. That makes it hard to track as a tax advisor. Finally, you want to keep in mind that tax-exempt interest from private activity municipal bonds can trigger or increase your AMT liability. However, any income from tax-exempt bonds that are issued in 2009 and 2010 is excluded from the AMT. Now, investment interest expense, and that is interest on debt used to buy assets held for investment. We typically see these as margin loans. That's going to be deductible for both regular tax and AMT tax purposes, but special rules apply. Your investment interest expense deduction is limited to your net investment income, which for the purposes of this deduction, not the net investment income tax, doesn't include long-term capital gains or qualified dividend income. And you reduce what's left over by other investment expenses. Any disallowed interest expense is carried forward, and you can deduct it in a later year if you've got excess net investment income. Now, here's a tax strategy. You may elect to treat net long-term capital gain or qualified dividends and count it as investment income in order to deduct more of your investment expense. But if you do, that portion of the long-term capital gain or dividend is going to be taxed at ordinary income tax rates. How do you know if you should do this? Run the numbers and see which one results in lower tax. Payments that a short seller makes to the stock lender in lieu of dividends can be deductible as an investment interest expense. Interest on debt that you've used to buy securities that pay tax-exempt income, things like municipal bonds, that's not deductible because it's already in a tax-advantaged state. Finally, you want to keep in mind that passive interest expense, that is interest on debt that's incurred to fund passive activity expenditures, that becomes part of your overall passive activity income or loss, and you're going to be subject to those applicable limitations there. I hope this helps give you some ideas on how to share this with your clients and get them eager about working with you to save tax. If you're looking for more ideas on advanced tax reduction or how to incorporate tax advisory services into your practice, check out the website on the next slide.